So what we're going to do is we're going to get started here. And if you're sitting on the sidelines waiting for the perfect moment to buy your first investment property, then I got to tell you something. The loan that you've been overlooking might be the exact reason why other investors are buying right now while you're still on the sideline. So today I'm breaking down 5 reasons that smart investors are using DSCR loans to build their portfolio faster with less friction and without handing over 2 years of tax returns to prove that they deserve it. I'm Jacob Ballew, Las Vegas luxury real estate agent and investor specialist resource. So if you're serious about building a real estate portfolio in the Vegas market or anywhere else in the country for that matter, then stick around because this is going to change how you think about financing and hopefully get you started on investing. So let's start with the basics before we get into the 5 reasons. A DSCR loan, which stands for Debt Service Coverage Ratio, is a type of investment property loan that qualifies you based on the income that the property generates and not your personal income. And that's huge. The lender looks at the rent that the property brings in versus the monthly debt obligation on that property. So if the numbers work on the deal itself, then guess what? You get funded. So that's the whole idea. Contrast that with a conventional loan. So with conventional financing, the lender's going to want to see your W-2s, your pay stubs, your tax returns, your employment history, and your full personal debt to income ratio. So if you're self-employed, 1099 contractor, business owner with aggressive write-offs, or somebody who's already got multiple finance properties, conventional loans can become a wall really quick. So DSCR was built for investors. Now here are the 5 reasons why it might be the right tool for your next or even your first deal. Reason number 1, your personal income is not a factor. This is the big one and why so many investors couldn't get a conventional loan approved have closed deals with DSCR financing instead. The lender is not looking at your W-2. They're not calling your employer. They're not running your personal debt to income or your DTI ratio against your car payment, your student loans, etc., right? So they're looking at one thing. Does the rent on this property cover the mortgage payment? So for self-employed investors, this is a game changer. If you've been in business for yourself for any period of time, you already know that your taxable income on paper often looks nothing like your actual financial situation. Your write-offs are a smart tax strategy right up until they make it almost impossible to qualify for a conventional loan. DSCR doesn't care about that. The deal qualifies the deal. Reason number 2, there is no cap on how many properties that you can finance. Conventional loans through Fannie Mae and Freddie Mac cap you at 10 financed properties. 10, that's it. So if you're a serious investor with a growth mindset, that ceiling is going to become a problem a lot sooner than you think. DSCR loans are not subject to that same limitation. Each property is underwritten on its own merits as a standalone asset, and that means that you can keep acquiring as long as you keep finding deals that cash flow. The investors who are building real portfolios in this market are not stopping at 10 doors. You need more than 10. They need a financing vehicle that scales with their ambition. DSCR is that vehicle. Here's reason number 3, faster and cleaner closings. So when you remove the personal income docs from the equation, you remove a significant portion of the paperwork that's really going to slow down your conventional loan, like just way down. No W-2s, no pay stubs, no employer verifications, no explanation letters for every large deposit in your bank account over the past couple of years. In a competitive market where sellers want certainty and speed, your ability to close clean on time is part of your offer. DSCR loans give you a cleaner process, which means fewer surprises late in the transaction and stronger credibility as a buyer when you're negotiating. Here's reason number 4. You can take title in an LLC. This one matters a lot from an asset protection standpoint, and most new investors don't realize that it's even an option. Conventional loans almost always require you to take title in your personal name, and that opens you up to your extreme liability, right? Your assets are exposed, and that liability is going to create because of the investment property, because of how you took title. With DSCR loans, many lenders will allow you to take title in an LLC from day one, and you're building your portfolio inside the entity structure that your attorney or your CPA recommended, instead of having to transfer the property later, which can trigger a due on sale clause. And that's going to create additional complications. So if you're serious about building a portfolio the right way, then owning inside an LLC is pretty standard. I mean, it's pretty common, and DSCR makes it accessible from the first property. Reason number 5, it forces the right investment discipline, and that's what this is all about. So here's the thing, DSCR financing, that I think is undervalued. The qualification is essentially the same question every good investor you should be asking before you buy anyway. Does the property pay for itself? If the rental income on the property covers that debt service, then you meet the threshold. So if it doesn't, then guess what? You don't qualify. That filter is actually doing you a favor. It keeps you from buying deals that don't cash flow and calling it investing. It aligns the lender's criteria with sound investment fundamentals. And when your financing vehicle requires that deal to make sense on its own, then you're building a portfolio with real cash flow from the start, instead of banking on appreciation, hoping that the math works later. Now, I want to address one thing that I hear pretty consistently, and that's people think that these loans are only for experienced investors, or that the rates, they're so much higher than conventional that they're not worth it. Let me be direct about both of these. First, there is no experience requirement. First-time investment property buyers use DSCR loans. The qualification is about the property's income potential, not your investing resume. Second, yes, DSCR rates are a little bit higher than a conventional owner-occupied loan rate, but you're not buying a primary residence. You're buying an income-producing asset, and the relevant question is not whether the rate is in isolation, it's the relevant question on whether the deal cash flows after accounting for that rate. If it does, the rate is the cost of doing business. If it doesn't, that's a deal problem, not a loan problem. The Las Vegas market in particular has been one of the strongest performing markets in the country for rental demand. We've got a landlord-friendly regulatory environment. We've got substantial population growth driven by relocation from high-cost coastal markets, and a tourism-driven economy that supports short-term rental performance, mid-term and long-term. So for investors who have been waiting to get into this market, the combination of strong rental fundamentals and flexible financing through DSCR is a real opportunity. So if you want to talk whether or not a DSCR loan makes sense for your specific deal, then you're going to want to explore what's available in the Vegas market as well. So please reach out to me directly through my website. Head on over to jacobandballew.com. I work with buyers and investors at every price point in this market, and I connect you with the right lending resources to make sure that you're positioned to move when the right deal comes along. So if this video helped you, or if you know somebody that's thinking about getting into investing, then send it to them. Now, this is here to make you think a little differently. So please hit the like button, subscribe, so that you don't miss the next one. I put content like this out every week on luxury, on real estate investing strategy, on what you need to know, whether it's first-time home buyers, etc. So this is also, you can buy and get your life to where you want to be. I'll see you guys in the next video.